upside surprise in wage inflation. They do not have strong conviction in a higher U.S. dollar prevailing, even on an outperformance in U.S. employment, especially if it comes without a clear uptick in wage inflation, which is the key variable in linking solid employment gains to an eventual pickup in inflation. But after 2 days of broad greenback weakness, particularly versus the commodity exporters, they believe that greenback could gain a temporary reprieve on a buoyant report that surprises on both job gains and wage inflation. A stronger dollar can and a sense that rate hikes in the U.S. remain alive could weigh on U.S. dollar-based commodity prices, including oil prices. So, if the employment change will be out at 175, between 175 and 250,000. 250,000, sorry, wage inflation is in line, and they see job gains in this range as consistent with further diminishing of slack in the labor market. But their directional conviction is fairly low in this range, and they worry that the dollar could show a similar pattern to the December employment release on Jan 8, whereby initial U.S. dollar strength is not sustained. And if the numbers will come out at 175 and below, wage inflation disappoints, a continuation of dollar long position liquidation would likely continue on a soft employment report as the market's current pricing of a prolonged pause in the Fed fund rate is emboldened by 1 month worth of soft payroll growth. That's according to the RBS trading desk. Let's move on. I have a couple of minutes more to go. Here you can see the top 10 economists surveyed on the matter, and according to their views, we have the survey summary. You can definitely read them out yourself. I would love to add a little bit on the projection. So, though that non-farm payroll would be a sharp step down, just created in December and the average 284 positions per month in the fourth quarter, it will largely reflect payback after the warmest temperature in years, bolstered hiring in weather-sensitive sectors like construction. January employment will also lose the lift from the hiring of couriers and messengers, which was buoyed in November and December by strong online holiday sales. An economist from Credit Suisse in New York says that payroll growth has been running above trend over the past 3 months. It's reasonable to expect a slower pace of payroll growth in the January data. Anything close to forecast will provide further evidence the labor market is still very strong. But coming in the wake of an abrupt slowdown in economic growth in the fourth quarter and a sharp stock market sell-off, the Labor Department's closely watched employment report could add to concerns. The U.S. economic outlook was deteriorating. And I would love to also share with you the community member sentiment on the impact on euro-dollar currency pair. As you can see, our traders are bearish this time. You can also see a couple of comments and economists from Stone and McCarthy Research Associates in Princeton, New Jersey says that we should recognize that the fourth quarter job growth was bloated by favorable weather conditions, and January was not. If I were on the Fed Policy Committee, I would not really change my mind. Markets have been turbulent. Financial conditions are less accommodative now. I may be less inclined to tighten now than I was in December. That is Ray Stone, an economist from Stone and McCarthy Research Associates in Princeton. And I guess it's about time we move on with the technical part, and Max, you're very welcome on board.
Thank you very much, Paulina. Hello, guys, one more time today. So yes, probably we have the most important data released this week today, which is the, of course, U.S. non-farm employment change, which is going to be accompanied by the wages data, very crucial, and of course the unemployment rate, which is partly dependent on the employment data we get in some 4 minutes from now. As for the expectations, they are quite negative this time, all because of that market turmoil we have had in January. There are risks that companies just stopped hiring new employees in January, and even though the ADP report back on Wednesday had showed us that the US economy created more than 200,000 jobs in January, the sentiment is still biased to the downside, and the expectations are fairly negative, just because also any number will most probably be a decline from the December strong number of 292,000. Speaking about the trading strategy, as you can see, we have the euro-dollar currency pair for the analysis. The currency pair has actually a slight bearish sentiment right now, but just a slight one, so almost 52% of all open positions are short on the euro and long on the US dollar. At the same time, I would like you to pay the attention more on the pending orders, because the vast majority of them, more than 60% in both 50 and 100 pip ranges from the spot price, which is at the moment 1.1205. They are placed to buy the euro against the American currency, meaning they expect the pair to continue appreciating as it has been doing for the last couple of days. Speaking about the possible market reactions from the current market price of 1.1205, let's have a look at the previous ones, of course, and the employment change from the US usually gives us the strongest reactions across the board. And as you can see, the average one for the last 5 months was 93 pips for the euro-dollar cross, which is a very strong reaction indeed. For instance, in November, the market reaction was as strong as 158 pips when we had a really positive surprise from the data. So taking into account actually the average as the benchmark, we can project that in case we have a negative surprise from the numbers, in case the US creates, let's say, less than 200,000 jobs for the first time since September, then we can project the euro spiking up to the monthly R3 resistance line at 1.1250, and gains are actually potentially can be extended up to the first daily resistance today at 1.1278. And in case, of course, a positive surprise takes place, in case the US continues generating hundreds of thousands of jobs, let's say 220 or more, we also can have a really positive reaction from the dollar, which can send the pair quite significantly back below 1.12. Mentioning the technical indicators, since I have just 30 seconds to go, they are actually also pointing to the upside on the most of the short-term time frames at the moment, so they are also bearish on the US currency right now. The pair has actually become a bit more volatile in the last couple of minutes before the release, so just we have a couple of seconds to go, and I think we already should have the breaking news and the first initial reaction from the market, which is to the upside for the euro, and let's wait for the numbers to come in. So yes, indeed, the US economy generated just 151,000 jobs in January. And the unemployment rate, even though it declined to 4.9% in January, possibly it's all because of the labor participation rate, which also moved the unemployment rate. The prior payrolls have been revised down to 262,000 for December. At the same time, we also have a positive surprise from the wages, which increased more than expected in January by 0.5 percentage point. So speaking about the initial reaction, the euro has actually spiked initially up to the first take profit at 112.50, but since then, accessing possibly the wages data and the unemployment rate, it has bounced back to the levels of pre-data release trading. Okay, I guess that for now that will be all from my side on the technical part for this particular data release. Thank you very much for your attention. See you all next week, and I give the floor back to you, Polina.
Thank you, Max. Yeah, the numbers have actually missed even the expectations for around, what was it, 4,000? And yeah, I guess that pretty much sums it up. And that was our last economic data release for today and for this week. Hope it was useful for some of you. Green tips to everybody, and a wonderful weekend ahead, and a wonderful DocDAO webinar ahead, because we still have algo wars. And here we go. There's the screen. Doc, you're very welcome to continue. Thank you. Bye.